Imagine this. You have just bought your investment property. You are excited, proud, and ready to build your wealth. Fast forward some years, you have built some equity in the property, but suddenly your borrowing power slows down, your tax bill goes up, and someone tells you you should have bought it under a trust. And you start wondering, what is the difference? Can one simple name on the title make a big difference? Hi, I'm John Sachdev from Admire Property Group, and in this video, I'm going to tell you the real truth about buying a property under your name versus through a trust, and how a wrong choice can cost you tens of thousands of dollars. Over the years, I have helped investors across Australia, from first home buyers to the investors with multiple properties. And one question keeps coming up every time: should I buy this property in my own name or under a trust? It might sound like a boring technical question, but it is not. The decision here will affect your tax, your borrowing power, your risk, your family wealth planning, and even how much will you pay in your land tax. So today we will go through it all. We will talk about what happens when you buy it in your name, what happens when you buy through a trust, the hidden traps that most investors don't know, how smart investors mix both of these to grow smartly, and finally, how you can work out which one works better for you. If you want to make smart property moves, hit subscribe and like the video. It helps in getting this message out to more investors. Alright, let's get into it. First one, buying in your own name. Most people start by buying property in their own name. It's the most straightforward way to buy. Let me give you an example. Imagine Lisa, who's a school teacher, and she's earning $90,000 in a year. She buys an investment property of worth $550,000 under her personal name. Everything is simple. The bank approves her application easily because she is a single applicant. She doesn't need legal structure, and her rental income goes straight into her personal tax returns. So here is what's good about it. It's quick, simple, and cheap, no setup cost. She gets negative gearing benefits. If her rent is $20,000 and the expenses from the properties are $26,000, so there is a difference of $6,000, which contributes towards the loss in her personal tax returns, and she saves the tax on it. If she holds the property for more than 12 months, she gets 50% capital gain tax when she sells. Pretty good, right? But here is the flip side. If Lisa ever gets sued in her work or in her business, her property is in her name, which means it is exposed. She could lose it in a legal claim. And as she grows her portfolio, every loan sits under her personal income, meaning her borrowing power gets tighter every time. Plus, her income rises every year. Her rental income is taxed at her personal marginal rate, which could go up to 47%. So, buying in your name is perfect for your first or second property. It's simple and flexible, but as your income grows, your risk grows, and your portfolio grows, it becomes expensive and limiting. So, the next one is buying under a trust. Now, let's talk about the trusts. Trust is a legal structure, a bit like a container which holds assets for someone else's benefit. Let's take another example. James and Julie run a business in Perth. They already have two investment properties under their personal name. So this time their accountants suggest them to buy the next one under a family discretionary trust with a company as a trustee. The trust buys $800,000 investment property, and this is how it helps them. It provides asset protection because the property is not owned by them personally. If their business faces a legal trouble or legal claim, their asset is protected. It allows income flexibility because the trust can distribute income and the capital gains to different family members. If the property is making $40,000, the $25,000 can go to a person who's at the lower tax rate, and another $15,000 can go to the adult kids who are not working. So it reduces their family tax bill. It is great for estate planning. When they are older, they can pass on the assets through trust without complicated transfers or probate. Sounds perfect, right? But here is the truth. I want to be super clear on this. A trust is a tool, not a magic solution. It's worth if it suits your goals and income. If you don't need its benefits, it could cost you more in long run. If you're unsure whether a trust would be beneficial for you, speak to a qualified accountant or a property lawyer before you decide. They will help you figure out whether it is beneficial for you or not. And next one is the hidden costs and the traps of the trust. Let's talk about the part which no one likes to mention, the traps. First one is negative gearing doesn't flow to you. So if your property is making 10,000 loss in a trust, that laws you can't use in your personal tax returns to reduce your tax bill, like you can do when it is in under your name. So the next one is a land tax. You pay a higher land tax in case of trust in most of the cases, depending upon the rules and regulations of the states. For example, in New South Wales and in Victoria, the threshold for trust is lower as compared to the individual threshold. For example, if you're holding a property of site value $400,000 in Victoria, you would be paying closer to $3,000 in the land tax only. So this is a real big cost which you need to factor in your calculations. The next one is setup and maintenance cost. Setting up a trust with the company as a trustee could cost you somewhere between $1,500 to $3,000 depending upon the accountant you use, and you have got yearly accounting and ASIC fees that could cost you $1,000 in a year. The next one is borrowing is harder in trust structure. Banks sees trust as complex structure. They ask for personal guarantees and might lower your borrowing power. And the approval process takes longer time. For example, in one of my clients' purchase, they went to three different lenders because they were buying under a trust. It was a unit trust. They went to three different lenders, but they didn't get the loan. And for the fourth one, they got the approval, but the whole approval process took a longer time. The next one is no main residence CGT exemption. If you ever lived in your trust owned property as owners and later on you sell it, you will not get capital gains tax exemption as you get as a homeowner. So trusts are powerful, but they are not one size fits all solution. You will have to run the numbers and you will have to make sure that that works for your situation. So the next question is how smart investors combine both. Most of the times investors start with small. They buy their first one or two properties under their name. It's simple, cheap, and helps in building equity and a borrowing track record. And then as their income grows and they add more properties, they start buying under a trust, especially higher value and positively geared properties. So many investors use a strategy called silo strategy. So silo strategy means buying an investment property in a trust. That means setting up a separate trust for different properties. So if one investment ever face any problem, any legal or financial, it doesn't affect the others. Take Jackson's example. He started with two properties under his own name, and the third one he bought under a trust. It was a positively geared property, so the rent takes care of all the costs. The loan sat inside the trust, so it didn't reduce its personal borrowing power. So he used the same model and bought next two properties under a trust, each secure and each independent. That's how the smart investors scale. They use the right structure at the right time. So next big question comes is what is right for you? Before I proceed to this section, I just want to remind you that I'm not a professional in this area. Make sure you talk to a qualified professional before you decide what is right for you. I'm just giving you a general information based on my experience. So coming back to the topic, so for deciding what's right for you, you should ask some questions to yourself. The first one is what is my income and risks? If you are a professional with low income and low risks, you should consider buying a property under your own name. But if you are a business professional and have got high risks of any legal lawsuit or any financial risks, you should consider buying a property under a trust. So next question is what is my growth plan? If you are considering buying only one or two properties, it's better to keep it as simple. And if you are considering buying more than five or six properties, you should consider buying them under a trust. Next question is can I afford the setup and ongoing costs? If you can afford it, then buy under a trust. If you can't, just keep it as simple and you can introduce the trust structures in your future purchases. And the next question is does the land tax and admin cost make sense? When you are buying under a trust, make sure you do the calculations for land tax in your cash flow analysis. And always remember, trust is just a tool, not a magic fix. It needs to fit your situation, your income, and your goals. And if you're unsure, make sure you talk to a qualified accountant or a property lawyer who understands investment structures. It is one of the best investment which you can do before you buy. So there you have it. Five key things to know about buying a property in your name versus through a trust. If you are early in your journey, buying in your name is simple, cost effective, and flexible. If you are further along, earning more and managing risks, a trust can be a smarter long term move, but only if the numbers justify it. So the wrong structures can cost you more, reduce your borrowing power, and can leave your assets exposed. So get the advice early, plan it right, and you will thank yourself later. So if you found this video helpful, make sure you subscribe, hit like, and forward it to your friends who are considering buying soon. And tell me in the comments below, would you rather keep the things simple and buy it in your name, or would you like to use trusts to protect your assets? I would love to hear what are you thinking about it after going through this video. I'm John Sachdev from Admire Property Group. Stay smart, invest wisely, and I will see you in my next video.